Let's start with the Coronation Top 20, the rationale behind it. Perhaps you can just highlight that for us, given its aggressive risk profile.
It's really a very concentrated portfolio of our top 20 best stocks. It looks like almost a bespoke kind of stock portfolio, typically that you would see in a private client stock manager. So it's the 20 best ideas at Coronation listed on the JSE and selected only from the top 50 shares on the JSE. So it really focuses on the large liquid shares with fairly concentrated views.
You've also highlighted that this is not for investors that can't stomach volatility, that short term you may take some pain, and the investment horizon that you are advocating is 5 years.
Yeah, look, I mean, we consider all equity investments to be long-term investments. So, certainly in any risk spectrum of an equity portfolio, we would at least advise clients to have a 5-year horizon. What makes the top 20 fund more volatile is that it's what we call a clean slate portfolio. We don't look at benchmarks when we construct the portfolio. The fact that a share like Billiton makes up 15% of the JSE, we're quite comfortable owning nothing in a share. That's a very big part of the benchmark. So what you see is over time, over short periods of time, the fund is very volatile relative to the benchmark. However, that's the way that we believe you can generate consistent alpha. And if you look at the fund's track record since inception, just over 10 years, I think just over 6% alpha per annum. We really think that's what drives long-term returns with short-term volatility.
Neville, I'm looking for my favorite stock, which is Richemont. I can't find it on your list there, which is top 10. So I don't know if it's in the bottom 10, but any reason why you've ignored it?
Yeah. Look, at Coronation, we're very strongly focused on valuation, very much valuation driven. We bought a lot of Richemont in 2009 when everyone was forecasting the world was coming to an end and luxury goods were going to be thrown out in favor of sackcloth and ashes. I think we bought Richemont at about 15 or 16 rand at that point in time. Subsequent to then, the world's come back very strongly. You've seen Richemont share price double in rands, I think triple in Swiss francs. And we've got to the point now where we think Richemont prices in most of the good news. It sits on, I think, 16, 17 times earnings. Earnings are fairly high. And even if the good news story does pan out in fast-growing regions like Southeast Asia, China, Middle East, we think that a lot of that's in the price at the moment.
And against that, I see you're quite heavily in Naspers at the moment. Do you still believe in the upside there, even though the valuations look fairly stretched?
Yeah, look, I mean, Naspers is a very interesting stock. There's a very great number of moving parts. We think the business that's particularly attractive at the moment is the African pay TV business, both South Africa and the great African continent. South Africa, we still think they've still been showing fantastic subscriber growth. We think there's still good margin opportunity in SA. But really, the big story is Africa, where along with the whole story, people get excited about the growing consumer, the growing wealth in Africa. Naspers are extremely well positioned to continue growing. You consider that they've got fewer subscribers in the rest of Africa than they do in just South Africa alone. You consider the addressable population of Africa over time. We think that's a fantastic business and probably one that's underappreciated by the market. If you strip the market value of Tencent, the Chinese internet business, out of the Naspers share price, we think you're only paying about a 5 or a 6 multiple for the rest of the businesses. So we would say pay TV is great, and then there's a host of other interesting internet businesses. There, Buscapay, which is the Latin American internet business. There's Tradus, which is the Eastern European, basically online. It's like the eBay of Eastern Europe business. So there's some very good businesses which are flying below the radar, which we think are potentially big value spinners over time for the group.
Neville, thanks very much for that update on both Richemont and Naspers. Looking at your top holding in your portfolio is MTN, and a moment ago I put the question to David, would he choose MTN or Vodacom? He said MTN definitely for the dividend, but I'm assuming that the value unlock, just listening to what you've said about Naspers, also comes from the Africa focus for MTN. Would that be a fair analogy?
Yeah, I think it's, both those reasons are very cogent, compelling arguments for making the investment. I think, MTN's exposure to under-penetrated, fast-growing African regions really sets it apart from a lot of other telco players which are mature in their markets. The people still aren't even sure how many people there are in Nigeria, so when they look at, subscriber penetration, there's continuously surprises to the upside. We still think that there's a lot of growth there. Some of the Middle Eastern regions, they're potentially, there's a couple of licenses there which are going to move from build, operate and transfer back to MTN. So we think that there's some exciting growth just in terms of subscriber numbers. Then I think if you look at what's happened with Vodacom as it's matured in the South African market, it's turned to be a very, very strong cash generator. Its dividend yield has kicked up quite sharply. And I think MTN, as some of those markets start to mature, without a doubt, you'll start to see the cash flow come back to shareholders, and you'll see very, very strong dividend growth. So it's really a two-pronged investment case.
Neville, you cut your teeth on financials. You were always well known in that area of the market. I see you've got Standard, you've got First Share. What's your outlook? Are banks a really good value play at the moment? They're going nowhere. They've been terrible underperformers this year. What's your view?
Look, I guess when you talk to banks, there's two things to take into account. The first is the domestic environment, and the second is the global environment, because, like it or not, our stocks ultimately are getting priced nowadays by foreign investors. And I mean, banks just globally have been under the cosh. There's still huge uncertainty around capital limits, about the regulatory environment going forward, about funding going forward. So generally banks around the world have had a torrid year. If you look overseas, a lot of very big banks are trading at below their book value, and a lot of that relates to the fact that people still are uncertain about how the regulatory environment is going to pan out and how much capital ultimately these banks are going to need. So then come back to SA, and while our banks have sailed through the global financial crisis and are extremely well capitalized, there is still no final certainty yet as to what the final capital requirements will be. And then on top of that, there's still a lot of pressure by the desire to meet the G20 first world standards of liquidity that banks have to meet going forward, which means that they're going to have to pay up for some of the liquidity. So these are some of the things that are hanging over them. That said, we actually think there is good value in the domestic banking sector.
But particularly, Neville, in Standard Bank,
interest rates.
In Standard Bank, as David pointed out, that's your third largest holding. And of course, we've seen all the negative news flow around Standard Bank of late. You're obviously betting on the positive side of the story.
Yeah, I mean, I think that's it's good. The bad news is out there. I think people have priced that in. I don't think people are expecting much from the bank. It trades on price to book, I think, of about 1.5 times. We've seen them start to rationalize some of their international investments. The sale of the Russian bank, talk of a lot of excess capital potentially being returned or again invested into Africa, where we do see growth, and we do see that South African banks potentially have got an advantage in order to grow. And then just the domestic environment, we see the cost of credit coming down, we see bad debt starting to unwind. So even though the top line is not growing that significantly, as that bad debt charge unwinds, we see earnings growing quite strongly. And I mean, you've started to see that already. The most recent Nedbank trading update certainly was very favorable. And Standard Bank, if you factor in, if you just look at the domestic business, SA is actually doing quite well at the moment. So it's one, and then you've got to look at the ratings. They're trading on forward earnings multiples, single digits, interest rate sensitive stocks. Compare them to the retailers on 12, 13 times forward. We think there's much better value sitting in the bank sector.
What makes up the tail of your... we've got your top 10 holdings, I think, which we pretty much discussed. What makes the tail, the bottom 10? Are you in retailers, industrials, or are you a bit of resources there?
It's a mix. I mean, there's some resources, things like Mondi sit in the tail. Impala, Platinum, I'm not too sure if that's in the top 10 or the bottom 10.
Bottom.
And then one or two specific stocks. So we do have investment in Woolworths, the one retailer that we do own. Primarily there because we think there's a particular story around operational efficiencies in that business. Has been a recent change in management. We think that, there's a lot of work that can be done on extracting efficiencies from Woolworths, as well as the fact that it was a business that was hit quite hard in the downturn, that expanded a lot of space, opened up a lot of space, and you're starting to see that space mature in their food stores, and you're actually seeing the leverage come through in the bottom line as that space matures.
Neville, we've got time for
Tongaat as well. Yep.
We've got time for just one more question. How often do you rotate stocks within your portfolio?
Look, ideally we'd like to be long-term investors and long-term holders. That said, we're not dogmatic, so we've got fairly strict disciplines around fair value, and if a stock reaches fair value and there's something else out there in the universe that looks more attractive, we'll buy it. Funnily enough, what we've seen over the last 2 to 3 years is the portfolio turnover at Coronation actually has picked up. And that's just because markets have been so volatile. Just take a big cap stock like Anglo's, which has a market cap of 150 or 200, 300 billion rand. That went from a price of 500 in 2008 down to a low of 150 in 2009, then back up to close to 400 last year, and now it's back down to 330. So you see huge volatility in the markets, and as a result, we've seen turnover pick up because we try and take advantage of when the market misprices assets.